and welcome to the Monday Futures Market Outlook for July 22nd, 2013. This is Patrick Ceresna. As always, we start off with the euro just to see where the currencies are trading, and we see that the euro has put in a short-term low back down over here and at the 128 level, the level where we were anticipating there to be a breakdown or a risk of a breakdown. Subsequently, we are now finding ourselves retracing right to the top end of the ranges. This doesn't make the euro neither bullish nor bearish. At this stage, the currencies are non-committal, and we'll be looking for when they do commit to trend as an indication of the potential implications to the other markets. But at this stage, the euro could easily still gravitate even 100 points higher up toward 133, and then still reject off of that zone. So it's really a mixed picture at this point on the currency front. Next here I want to take a look at crude oil, and crude had a very meaningful breakout above the 98 to 100 zone back over here, and has now been in a full rally mode approaching $108. There was numerous highs that occurred back in 2012 and 2011 around this 110 level area, so there's certainly room for further strength up into overhead resistance, and we could even potentially see as high as 114, 116 on the upside during this push. This is already an overbought and overextended move, so while we are suggesting some higher targets, at some juncture we anticipate there to be a natural throwback. That doesn't make us bearish crude oil, but simply identifying that the risk-reward proposition of chasing it higher is diminishing. And so when we have throwbacks in crude, maybe back down to 104, 102, we can see whether or not those supports represent buy on dip opportunities. Next here I want to look at gold, and gold has now put in a short-term bottom for certain. It's about whether or not it's an intermediate bottom that we're going to try to investigate at this stage. With this bounce coming back, we were even last week and the week before suggesting there was room for a bounce back to 1350, which is a natural retracement zone. Once we get up into this zone over here, it becomes increasingly vulnerable that gold will yet again have to prove that that a bottom is in, which at some stage we could even see a $50 to $100 an ounce pullback off the highs, which subsequently prove or will test the validity of a short-term bottom. At that stage, that could become an intermediate bottom from which gold can do a much more meaningful rally to the upside. That's something that we do believe can happen in the third quarter, going into the fourth quarter of the year. But at the same time, we don't believe that everyone should be rushing to load the boat here just yet. We want to see where the price action stabilizes, whether it stops making lower lows, and whether everything starts to develop a far more bullish price action. At this stage, we can only speculate. Next year I want to look at the 10-year Treasury bond, and we now have seen a short-term low. We were identifying that low from 2012 and down along the 123 handle, but at this stage with this short-term low, we're now seeing a meaningful bounce as the language from the Fed has come off a little bit, which has allowed the bond market to get off its worst levels. We are not prepared to become outright bullish bonds, but we do believe that there is room for bonds to continue to work their way back and retrace a good chunk of this move. We don't necessarily at this point believe that that's going to be the start of a brand new meaningful rally, but expecting there to be even further bouncing or further retracing higher up to, let's say, the 129 handle is something that would be quite natural in the way that the price action moves. Finally, when we take a look at the S&P 500, we had another bullish breakout off of that short-term low that developed off that 1550 test. At this stage, we are completing a measured move up to the 1700 and 1720 level up along here. Anywhere along here is where we're initially looking for overhead resistance. At the same time, there is from a proportionality perspective, if you look at other past rallies, there is room for even 1750 1750 to be tested. In order for 1750 to be hit, you would have to take a further new input catalyst in order to drive momentum that high. It is something that is possible, so we'll watch to see how the price action develops. The key thing here is that as we approach the 1700, 1750 level, this could be where the highs of the year develop. And so even though if you're long the market, we're looking for even up to another 50 points higher, and probably still weeks away from a meaningful market correction, you can certainly try to make further profits from the upside move. But understand that as the market rallies up here, there's a diminishing benefit from a risk-reward perspective for not lightening up on your positions and subsequently locking in some profits. And so try to make the most out of this rally on the upside, but you should already be planning an exit strategy as we get up into the target zones. That was your Monday Futures Market Outlook. Thank you for joining me.